So today what we're going to do is we're going to really go through the whole understanding of digital assets and blockchain. So if you've got any questions as we move through, please ask them. So the first question I have for you guys is what do you know about crypto? Six? So do you invest in crypto?
Before, but not like actively.
You're not active, but do you hold any crypto?
Not anymore, no. Not since the crash.
Traceable.
Yep. Yep, so decentralized currency, it's not in a bank, it's on a blockchain. It means that you own the currency, it's your currency if you store it in a wallet. So you are now the bank. Yep. So that's pretty much what digital currencies are around. So you've got store of value, you've got a use for it, which is to spend it on items. Have you tried to do that? Have you tried any opportunities to spend it?
No, I just traded it. I just got it in and then
Yeah.
sold it when it was more expensive.
Great. So you've been trading it. Yep. So you have used it to accumulate wealth, and then you've traded the coin and put it back into fiat currency. So you've decentralized your money, and then you've re-centralized your money back to a fiat currency. So the argument for cryptocurrencies is why would you do that? In the future, cryptocurrencies on the blockchain will take over from banks, and they will start to become the way that you trade and buy and sell. So fiat currencies have problems of their own. We'll talk about those in a moment. Okay, so cryptocurrencies is not just about trading. It's not just about storing value. There's a lot more going on. So that's what we're going to look at today. So the nature of this presentation is to try and get you to understand what a digital asset is. So are you guys into social media? Okay, so what if you got paid for every time you posted? Would that be a good idea? What if you got paid every time you looked at posts? Would that be a good idea? Okay, blockchain, cryptocurrencies in the future will allow that. So rather than giving all your money to Facebook and making Mark Zuckerberg a multi-billionaire, wouldn't it be nice if we shared in the wealth, because we are contributors to his wealth? By contributing to his network of Facebook over the last 15 years, he's managed to accumulate $100 billion. That money is used to lavish his lifestyle, and it's off the back of people like yourself and me and your grandmother and your granny and your mum and your dad, who've all contributed to a huge network of social media. So cryptocurrency, because it decentralizes wealth, is going to enable people like you and me, when we like a product and we get involved in a product, to also benefit financially from that product. Yeah? Okay. So let's dive in. So my name's Andy Hurst. I'm a senior lecturer at Derby University. I teach on the marketing programme. Yeah. I'll just declare that I've got some cryptocurrencies. I'm holding Bitcoin, Ether, XRP, XLM, Link, Sol, ADA, Litecoin, EVAX, Dogecoin. So I've got a whole range of cryptocurrencies. It's roughly in that order. So Bitcoin is your store of wealth. It's the most advanced cryptocurrency in terms of market traction. It's the one that was invented first. All the other currencies are basically modifications of your Bitcoin. So holding Bitcoin is probably an important part of any portfolio, because that has 49% of the market, whereas the others have a very small portion. Ether is your second biggest cryptocurrency with about 20%. So buying into these other ones is risky. It's a risk asset. They go up and down very quickly. But what I want you to think about is the long-term gains, the long-term traction of crypto, and where we're moving to. So what I want you to think about is keeping the year 2031 in your mind, because that is the year where we're likely to see full adoption of blockchain and cryptocurrencies. So we're not far away, right? 7 years. Full adoption, 1 billion users of crypto. So there's a long way to go. You're talking about 200 million people at the moment getting involved in crypto. So there's quite a way to go, but it's got a lot of traction. I've been around a long time. So I was born in the 80s when there was no computers. So I was born in the 70s. There wasn't any computers that you used, right? There were big mainframes in big rooms. They were used for very specific purposes. At the end of the 70s, they invented personal computing. You could buy a BBC microcomputer, you could buy a ZX Spectrum, you could buy a computer like that. A few years later, I think 1982, IBM created the first desktop computer. It wasn't until 92 when we got the internet. You couldn't use it until Windows was 95 was created in 95, 96, and that's when Netscape bought out their browser. And in 2000, 15 years later, we had a dot-com bubble, and the market crashed in terms of website development. So a lot of companies went bust. But the ones who got in early, in 96, Amazon, companies like that, are still thriving today. Over the last 30 years, we've gone through 3 phases of the internet. Web 1, which is your basic display websites, simple websites that you can interact with, through to Web 2, which is the development of mobile technologies and social media and apps. Now we're entering into Web 3. So blockchain is the next iteration of the global internet. So it's important for you to be well aware that blockchain is not just a cryptocurrency. Blockchain is a technology, and it's changing the way we operate globally. It's going to remove some of the friction from transactions. It's going to remove some of the complexity around trade. So it's globalizing finance. If you think about it at the moment, where does your money go? It goes to your bank, yeah? And you go to your local HSBC, you go to your local Bank of Scotland, whatever it is, yeah? NatWest, Barclays. But your money's not stored in that bank, right? Your money doesn't actually exist. It's a digital currency already. The Bank of England is a national bank, and they try to protect us from inflationary shocks and all sorts of other major issues that go on globally. What you'll see over the next 10 years is the reduction of these localized banks. National banks will start to disappear, which they've started to do already. So El Salvador is the first country to operate blockchain and use Bitcoin as a currency. And yesterday, their cryptocurrency policy of buying 1 Bitcoin per week, 1 Bitcoin per day since 2020 has now started to become profitable. So you talk about the buying through the crash. El Salvador bought at the top of the market in the last cycle, but they continued to buy Bitcoin every day, and now they've gone through the whole up cycle, down cycle, and now back into profit. So El Salvador have fully embraced the concept of Bitcoin as a currency. So now we've got one country, decentralizing their banking. One. There's 155 to go. So the next 10 years, you're going to see this decentralization take place. So it's going to be very fascinating for you and something that you need to keep an eye on as a graduate. Okay, so what the workshop's going to be about, we're going to talk about blockchain and crypto, we're going to talk about the history of crypto, where it's come from, why did it become a big thing, how to start in crypto, its impact on marketing, and where it's going to go. So we're going to go through the whole storyline to make sure that you guys are fully aware of this environment. So we might use the word blockchain, might use the word crypto, we might use the word digital assets. If you get confused at any moment, just say so. So blockchain is a technology. Cryptocurrencies are an application of that technology. Digital assets is the collective noun for those applications. So some people have NFTs on their phone, so images that they've bought, or they've got cryptocurrencies. There isn't many other utilities of blockchain at the moment. There isn't any other applications that exist. If you think of any that you want to share them. We'll talk about some of the applications that are coming through in a little bit later on and how they work in marketing. Yeah? So just to scare you, this is the number of dollars that are in circulation. So a very static amount of currency development in the 1920s. And then the US started to change its policy on how it was going to manage inflation. And it went from using gold as the gold standard and creating currency that they traded on the back of the value of gold that they held. And they changed the way they did it and started to use debt as a way to print more money. So the US treasuries would create bonds. People would buy those bonds as long-term debt assets, and the US government on the back of that would then print more money. And when we had the dot-com bubble, when we had the financial crisis in 2007, to stop the entire financial system globally going under, the US issued billions and billions and billions of dollars of debt and created billions and billions and billions of dollars of additional finance. Made up money doesn't exist. It just circulates as a debt around the globe. And this is what has instigated the thought around cryptocurrencies. So Bitcoin emerged off the back of this problem. The white paper Satoshi Nakamoto wrote the year after the financial crisis in 2008 and said we need to decentralize money, peer-to-peer money. I'm going to create a currency which you can't debase, that you can't print more of, and I'm going to release it, and we're going to decentralize it, and the creation of that money is going to be through a technique called mining, so crypto mining. So does everybody understand the concept of Bitcoin? Do you understand how Bitcoin is created?
I already get mining, but I understand.
Yep. So they've used some old-fashioned tech terms like mining to describe something that is actually software. Okay, do you understand Bitcoin? Yeah. So just to quickly explain, just to make sure you're on the same page as me. Basically, it's a program. The program is run by multiple nodes or miners, and each of those miners are trying to find a number. And they're running a random number generator on a protocol, software protocol. And when one of those miners lands on that particular number, just like the lottery, they win, and they get given a Bitcoin. In the early days, they got given a lot of Bitcoin. In the future, they'll get given hardly any Bitcoin. The neatness of Bitcoin is that you will get less and less of it over time. It gets harder and harder to find the number. The challenge to get the number random generator gets harder and harder to find the number. So it has a natural slowing down process. And then of course the main thing is it's automatic. No one controls it except the miners.
CEO or anything with Bitcoin? Is it just all?
That's right. There's no founders. There's no foundation like XRP or Ethereum or those coins. Nobody owns it. If you want to own it, you can do. You can get a node. You can create a node. Basically, you can start mining on Bitcoin. If you are a node, and if you can go onto the website, Bitcoin website, you can get all the programming and language. You can get all the code, and you can set up. We're not going to do that because it's not our job. We're marketeers, right? So we'll let the computer scientists get involved in that. Let them do all that. But you could mine it and have control over it. You could mine other coins if you wanted to, and you could set up. It costs about £1,000. If you try to mine Bitcoin on your own, you're not going to land on the magic number very easily because everybody else is competing with you. And there are thousands and thousands of mining programs running all at the same time trying to find that secret number. So what you can do, and we'll talk about it in a bit more detail later, is you can be part of a pool and you can get your mining technology, you can link it to a mining pool, and then you become part of a mining system where other computers are involved, and hopefully your mining pool discovers those Bitcoins. Because that's the only way you're going to get paid. Okay, so that's why Bitcoin evolved. The US, the British government, lots of governments around the world started printing money to stop banks collapsing. The Lehman Brothers, failed, and it put panic into the world economy. You're living with that debt. You're living with that problem. Your entire careers are based on that particular problem. Because it devalues your currency, it devalues your spending power. Yep. It makes everything more expensive in the long run. So people are interested in Bitcoin, they're interested in cryptocurrencies because they're trying to avoid this problem and they're trying to get back at the system. Okay, so a digital asset is generally anything that is created and stored digitally, is identifiable and discoverable, and it provides value. Okay, so in the digital landscape, there are three main aspects that you can think about. There is Bitcoin, a decentralized store of value. There are a whole raft of altcoins, coins that have been developed on the back of the Bitcoin protocol. Do you know you can get your hands on the Bitcoin protocol? You can set your own Bitcoin up if you wanted to. Yep. So you can go to a site called GitHub, and you can download it. It's open source. It's freely available. Altcoins are alternative coins. They are set up to do specific jobs. So people have set up altcoins to decentralize gaming, decentralize finance, decentralize gambling, whole host of different applications, decentralize social media. And what we'll see is some of these working and some of these not working. So some of these altcoins are going to fail. So when you invest in an alternative coin, you are really investing in an idea. You're investing in the future value of that network. And you need to get lots of other people to agree with you, otherwise your coin's going to disappear. Okay? So it's a bit like venture capital. So by buying altcoins, you are a venture capitalist. Yep. But only a little micro venture capitalist, because you don't have to buy billions of dollars of a business, millions of dollars of a business. You can buy pennies in a business and still get that value. Yep. Along with your altcoins, you have other applications. So Ethereum have become renowned for the concept of the smart contract. So you can create contracts which don't need to have any legal interventions or intermediaries and middlemen. You can automate smart contracts to process decisions, whether it's supply chain, transferring of documentation, whether it's buying other assets. It could even be the transfer of footballers to one club to another in the future. Every time you make a contract, you need a lawyer. Smart contracts are going to remove that middleman from the decision-making process. Not completely, obviously, because you'll need someone to support the contract development. But when you've got thousands and thousands of transactions, you can reduce the cost and the friction between those decisions of whether to buy or not to buy with your smart contracts. NFTs became very popular. Non-fungible tokens. These are encryption codes that get added to an asset. And it could be an image, it could be a physical asset. Yep. And you can then trade that on the blockchain. So again, NFTs will change the way we operate in social media space. So every time you take a photo and upload it, in the future, it'll have an NFT code. It has a value. If someone wants to use that, repost it, you get paid in a micro amount. Won't be a lot, obviously, but you'll get paid because it belongs to you. As soon as you put it online, guess who it belongs to? Facebook. It belongs to all those centralized social media companies that you've just given all your data to. So the future is to remove that centralization and give back ownership to the individuals who created it. Okay, so just want to try and give you a kind of heads up now on the structure of crypto and how they all fit together. So if you want to be interested in crypto, you need a wallet. And there are different wallets, but if you want a decentralized wallet, you need to go and get one online. There are lots of companies that offer that. Crypto.com, Kraken, Coinbase, Binance. They have supplied the opportunity to have a cryptographic wallet. Okay? So you need a wallet. And in order for that wallet to work, you need to be able to transfer some money into it. So you need to interact with your bank. If you want to trade and swap your coins around, you need to engage with a digital exchange. If your crypto is not stored in your wallet, you don't own it. Okay? You don't own it. So it's marked in red because if it's in there, it's yours. If it's out of there, it's not yours. So how does crypto work? Okay, so what are you doing when you buy crypto? What you're doing when you buy Bitcoin, altcoins, okay, you are funding what we call the layer 1 blockchain, the foundations of the industry. And what people in Ethereum want you to do is to buy their coin, because the more you buy of it, the bigger that platform becomes. The bigger that platform becomes, the more useful it is to other people to use it, because it's it's a consistent currency across lots and lots of people. So by buying into your layer 1, you are funding a new service, a new blockchain. So the bigger the blockchain gets, the better the blockchain will be, and we'll talk about network effects a bit later on. So engaging with your layer 1, you have your miners, and potentially you have your founders who've created it. So when layer 1 get created by founders, they skim some of the coins off. They keep some of the coins back and hold them for themselves. Okay, and they use the value and the increasing value of those coins to reinvest in their layer 1 blockchain by creating tools and interactive components to go along with it. And they can lead to what we call layer 2 or DApps, decentralized applications. So what you've got are a bunch of firms that create the layer 2 decentralized applications. And they build them on this big foundation that we've all contributed to. From there, we're going to have commercial clients, businesses investing in Web3 technologies. Yep. Any questions on that? So this is the structure at the moment. This is what the expected structure is going to look like. So there are lots of layer 1s, and there are also lots of layer 2s. And each of them all have their own coins, and they're interacting differently. If you were a business guy and you were setting up a business tomorrow, you wanted to make it as simple as possible for yourself. You wouldn't want to create the layer 1 and build it up over time, would you? Because what you want to do is get trading straight away and make some money. It's the same as saying we wouldn't create the marketplace in the centre of Derby to run a market stall. It wouldn't make sense, would it? We want somebody else to put the effort in, create the marketplace, and then we'll come along as entrepreneurs and we'll put our store there and we'll sell our goods and services. So your layer 1 is your market. Your layer 2 is your traders. And then you've got your customers. And your customers will either be you interacting with the services or commercial clients develop products and services for their customers. Okay? So there's lots of different cryptocurrencies. At the last count there's over 10,000. I think there's about 30,000 now. People are creating them all the time. And you've got to be very careful because a lot of them are valueless. They are projects, ideas. They have no value until they become useful, have a utility. So any of you guys buying into altcoins, be careful what you're buying into, because it could be nothing at all. It could be just dust in the wind. Okay, so what I've listed here are some of the bigger ones. So you've got Dogecoin. This is a cryptocurrency that is trying to add value to memes. So when you create crazy memes, post them online, the idea is eventually you'll be able to trade those and create those and create some income from them. Ether is a multi-purpose layer 1 blockchain. It's known for its smart contracts. It's also known for being the biggest layer 1 to hold NFTs. So all the big NFT concepts that you've heard about, Bored Ape, images and art, are all held on Ethereum platform. Bitcoin is considered to be a store of value, and people refer to it as digital gold. Ripple XRP is trying to reduce the friction between banking transactions, make them cheaper, take out the middleman from banking transactions. So in banking you have clearing houses. So when money goes from one bank to another bank, it firstly goes to a clearing house. then from that clearinghouse to the other bank. The process is very clunky and it's very expensive because the clearinghouse want their slice of the cake. So every time a bank moves money around, they're paying for the clearinghouse to deliver that to the next bank. Solano is trying to atomize real-world assets, which is a quite complicated concept, really. But the idea is as asset values start to rise and rise and rise, people like you in Gen Z are going to find that it gets more and more unaffordable to buy property. Unless you make it rich, it's going to be harder and harder and harder in time to buy those assets because they're just going to keep going up and up and up and up. But your wage is not going to go up at the same rate. So buying a house now, you can get mortgages 8 times your salary. When I was your age, you could get a mortgage. You could only get a mortgage for 2.5 times your salary. Because houses weren't that expensive. Now you need a 50-year mortgage to get a property. More debt. Reducing the fiat currency value over time. So rather than save up all your money in a bank account, in your savings account, what about investing in cryptocurrencies, in blockchain, in Bitcoin? Yep. And over time, you'll find that your money goes up in value rather than decreases in value. Now, rather than put it all in Bitcoin, what you could do is you could buy into those properties that are getting built. But rather than buying the whole building, which is too expensive, you buy a very small fraction of a building. But as the asset increases in value, your share also increases in value. So you're staying on the property ladder for the whole of your life cycle. Yep. And eventually, if you do that in the blockchain, you will eventually have enough funding to then take that money and then buy the real asset yourself. So Solano are trying to make that happen through the concept of atomizing real-world assets. Tether is a stable coin. Do we know what a stable coin is? You aware of stable coins? Excellent. Yeah. So we've had a few horror stories around stable coins where someone used artificial intelligence to predict the value. And when we had a very fast spike in value, the AI didn't respond quick enough and it completely destroyed the stable coin. So in the future, you're only going to be able to have stable coins that are one-for-one fiat currency based. So if you are a Tether, you have to hold the same amount of dollars as there are in circulation on your blockchain. So when the coin goes up in value, you have to offset that by buying and selling more of your coin. Okay. Over the next 2 years, you're going to see the emergence of central bank digital currencies. So at the moment, the EU are creating a stable coin called an e-euro. It's not got a name yet. It's called e-euro. They're testing it out to see whether or not they can actually have a digital blockchain currency running in Europe. So lots of activity is going on. So you can see here that you've got lots of different currencies doing lots of different things. If you want to invest, you need to read and understand each project that you're investing in and then decide for yourself whether it's something that you're interested in supporting or not. Okay? So there are lots of different types of digital wallets. Some are centralized, some aren't. At the moment, there are lots of centralized digital wallets. If you go on your mobile phone now, you can get into your bank, can't you? That's a centralized digital wallet. If you buy through PayPal and store money on PayPal, it's a centralized digital wallet. Yep. You don't own the money that's in those digital centralized wallets. The bank owns the money. So in order for you to be on a blockchain, you need to get involved in decentralized wallets. And you can get hold of those decentralized wallets. And there are a whole bunch of different ones. But with centralized wallets, you can store all your information. You've got a password. And if some criminal decides to take your money, they get your password, access your bank account, and take your money. When you have a decentralized wallet, you're given a private key, an encryption code. Only you know that encryption code. It's called a seed phrase. If that seed phrase is lost and you lose access to your wallet, you can't recover your funds because there's nobody else left to ask. With a decentralized bank account, centralized wallet, you can ask your bank to reset your password. But with a decentralized wallet, there's no one to ask. You can't reset your password. So you have to have a good custodial policy for your seed phrase. And because if you lose it, your money's gone. Yes, you can get access to your wallets. If you've got a hot wallet, it will have a password. But if that company goes broke and stops supplying you with access to that hot wallet, you still have your money encrypted on a blockchain, but you will need your seed phrase to get access to it. So in the future, you're going to have hackers and thieves trying to find out what your seed phrase is. So there'll be crypto crimes, people holding people hostage, saying, where's your seed phrase? To get access to people's money. So that's going to be some of the problems around holding a digital wallet on a blockchain. So what you can do is you can get a little metal plate and you basically write down your seed phrase, which are a bunch of words, and you store that somewhere. You can store it on paper if you wanted to. If you store it on paper and you have a fire, the paper burns. Yep. If you have a flood, it gets wet and soggy and all the ink runs. So the recommendation is that you get a metal plate and you stamp in your seed phrase and then you store that somewhere safe. So you've got digital wallets, hot wallets which interact with exchanges and Web3 technologies, cold wallets which are on the blockchain and not connected to any other services. It's recommended you get yourself cold wallets and store your crypto in those. So it's not tamperable, so there's no way of getting access to it except through the seed phrase. You can also buy a hardware wallet, a little device that you carry around with you with your money on it. But obviously you've got problems with that because if you carry it around with you and you lose it, you've then got to go and buy another hard wallet, recover your seed phrase and reinstigate your crypto back onto the hard wallet. So it can be good to have a hard wallet. It does take it off centralized exchanges, but there are risks to it. If your money is in an exchange, so you're trading, it's still centralized. It's in that crypto environment that's accessible to the company that you've got your wallet with. So for example, Coinbase have their exchange in one app and they have a digital wallet in another app. The two are separated. If you take your money from your wallet and put it in the digital exchange and Coinbase go broke, they could take all your money. So unless you are actively trading all the time, you should store your money in your cold or hot wallet so you've got it safe. Until it's in there, it's not yours. Yep. Not your keys, not your coins, they say, that's the phrase. So, never lose or forget your seed phrase. Store it well, keep it safe, Put it somewhere where nobody else can get access to it. Not even your children. Yep. Or your wife, or your girlfriend, or your mother, or your best friend. Because that is your wealth being stored. I said earlier, the banking crisis started this whole thing off. The collapse of banks and the recovery of banks by central banks, created the impetus to decentralise currencies, stop the concept of money printing. From there, things have started to take off. We've talked about the internet web 1, 2 and 3. Just quickly talk about ownership in the digital world and where it's evolved from. So if you go back into the early 1990s, it was fun to go on the internet with your desktop, Leighton, and you could download CDs through BitTorrent. Have you heard of BitTorrent? So the concept of peer-to-peer was created in the 90s. I could send something to you. I could post some information online and I could download it from another computer. When I downloaded it, it could have loads of bugs and viruses installed in it. I wouldn't know. But no one cared in the 90s. No one really understood it properly. But also, I can download it from you for free. So I could now go on the internet, I could access a world of music and videos and films, and I could download them onto my PC. And of course, what we're doing there is we're infringing copyright, aren't we? We are taking something that we don't own. We are using music and using films which we don't own, and we're copying it without permission from the owners. The owners are the artists, the movie makers, A company called Napster was set up, and they deliberately provided a website where you could get all this downloaded material. And the US government said, okay, we've had enough of this. You are stealing property. You are allowing people to share this information, this music, this film. And they rounded all the people up who created Napster, put a few people in jail. Some people left the country and ran away to the Eastern Europe. But what they'd done is created something really quite interesting and unique, but they were doing it illegally. And then along came Apple and said, hey, iTunes. And iTunes emerged as a legal way to download music. So now we had an internet where you could buy music and you could download it onto your iPod and you could listen to it wherever you wanted, store it wherever you wanted. If you want to find out a little bit more about the iTunes story, read Chris Anderson's book. But the whole process of iTunes was that iTunes got control of the music. Music producers had to give iTunes their songs. iTunes would sell their songs, and every time they sold a song, they made 40%, and they still do to this day. So they make an absolute killing. So the artists were not getting as much revenue, and now artists get hardly any money from the sale of music because iTunes is taking it all, and you've got Spotify and those companies as well now. These environments are what we call walled gardens. Yep. If iTunes didn't exist, you wouldn't have access to that music. If iTunes closed down tomorrow, it won't do, all the things that you've bought in iTunes Store, you would no longer have permission to use. You'd have no record of that use either. So you wouldn't be able to transfer that ownership anywhere else. You can't transport your iTunes account to Spotify. These These companies are walled gardens created to make a maximum profit for them. It's a centralized environment. And the same thing happens in the gaming industry. If you like Fortnite or Call of Duty, you can buy skins and guns and all sorts of various digital assets, but you don't own them. Yeah? You don't own them. What you do is you rent them off the game company. Because if that game shut down tomorrow, your ownership goes with it. They are walled gardens. They exist. You own it while it exists. You can't take it beyond the organisation because you don't fully own the asset. So these concepts have made people billions and billions of dollars. The idea is that, well, if you make something in a game, why can't you sell and trade that asset? You put the effort in, you put the work in, why can't you make some profit from that? You're also contributing to the network and making the game better as a consequence of your actions. If you play it for long enough, you're contributing to the network because you're giving other people in the game an opportunity to play. Why can't you benefit from that? Okay? So the only way we can get to that stage is to decentralize, and get stuff logged and coded so that we can record who owns what on a wider framework. And that's where foundation blockchains come in, because if you have a foundation blockchain, you can take it off a game and you can transport it to another game. So companies like Nike and Adidas have seen this opportunity and they think, hey, hang about, people play in the virtual world, 50% of their day is spent in a virtual environment. Well, what if we were to sell people virtual running shoes? Wouldn't that be interesting? So when we're running around Fortnite, we can be wearing our trainers. Yep. So Adidas and Nike have been looking into that a lot. Now, some people are trading accounts in games. So World of Warcraft, people create a character and they get it up to level 60 or something like that, and then they sell it in the darknet to another person, and they buy the password and access to World of Warcraft. People are making money from these digital assets, but they still don't own it, because if World of Warcraft shut down, those digital assets disappear into thin air. So we need a simpler way to get the money moved around. We don't want people to come out of these digital environments back into fiat currencies and back into a digital environment. What we want is a currency which we can trade in and around that virtual space. And that's where cryptocurrencies help a lot. But we want to do it in a way where we don't need third parties to engage in the transaction. Because, say for example, I was to sell you a character and I gave you a fake password or I gave you fake details, I could rip you off because you have to transfer your money from your bank account to my bank account. And then I have to transfer my password and login details from me to you. At some point, you're going to get scammed. Now, if I was to sell it with a virtual currency, we would know immediately whether or not we've transferred the cash and transferred the ownership. So we can do it very easily. So there's lots to come in the crypto world. This is the trajectory which we're working to. So I said earlier on that we're looking at 2031. 2031 is our first billion customer. This gold line here is the trajectory of the internet. So if you go back to 1990, we had about 1 million users, right? 2009, we've got a billion users. Obviously today we've got 5 billion users, right? So the internet is fully deployed across the world almost. And with Elon Musk's satellites, those hard to reach places around the globe are going to be reached. So we're going to get to full internet capacity over the next few years. So that's the trajectory from 1990 up to 2009. What we're going to do, so these other lines here are your monthly and yearly transactions on the blockchains. And if we look at the growth in those, we can see there's an interesting relationship with the previous internet development. Yeah? Understand? So if we traject out these dotted lines, we're hopefully going to get to 1 billion users by around 2030, 2031. Yep. So we've mapped current adoption with the internet adoption in the early days, and to get to 1 billion looks like it's going to be about 7 years away. Yeah? Questions? So we're not looking at a very long time period here. Yeah? The money that you can make from crypto is in the next 5 years from exploiting the speculation in the market. As we get to 1 billion users, the speculative element's going to drift off. It's going to disappear a lot, especially around Bitcoin and currencies like that, because so many people have it, it becomes more stable. People aren't trading it in such a volatile way. Yep. So why are people buying it at the moment? Here's some current data. Primary reason for owning virtual currencies: investment. So most people are doing exactly what you're doing. They're buying it, holding it, assuming it's going to go up in value. They might be trading it as well. But most people are buying it as a long-term investment. They don't want to miss the boat. They think that if they buy in now and hold it, it might be worth something in the future. Yep. But if you notice here, there's hardly any utility in it at all. To pay for items, yep, no one is using it for that. International payments, no one is using it for that. There are some people who don't trust banks, yeah? Some people who believe in the fiat currency problem of deflation, and they're buying it because they don't trust banks. They want to store it for themselves. It's the classic putting your money under the mattress. Yep. Here's another study by a student of mine. People are looking at high returns and profit maximisation. It's one of the biggest drivers of it. High returns, short-term profit. So you can see that people who are using cryptocurrencies at the moment are speculators. They're buying it because they think it's going to go up in value. They're either buying it because it's got volatility, so you can buy and sell highs and lows and make some profit. So the market is driven by those micro factors. Let's have a look at some macroeconomic drivers. The first one is the concept of the evolution of money theory. And people have kind of looked at Bitcoin as a kind of start-up new money, right? And what they believe that is, first of all, items become collectible. And if you go back to the Stone Age, people used to collect nice shells on the seashore. Used to collect the shells and they used to trade the shells. People used to make necklaces out of them. They had a collectible value and store of value. If you collected enough shells, you could trade them. So you could actually hold these shells and it'd make you some profit in the future. So you could store some value. you could use the shells to exchange for other shells or stones or precious stones or other items, skins. And then eventually, the concept of money is that it becomes a unit of account. You can quantify what one shell is worth. We could do that with paper money. We could do that with gold. But now, because of the way currencies are managed by central banks, they've decoupled the value of the cash. They've turned it into a debt product. So the more debt created, the more cash gets created, which devalues the currency over time. So they've delinked, decoupled the unit of account from existing money. So NFTs and Bitcoin are collectible. They are a store of value. They are a medium of exchange, but no one's using them much. Eventually, they'll become a unit of account. So the money theorists, the evolution of money theorists, believe that we're on a journey to unit of account. And at the moment, we're further down this way at store of value with Bitcoin. People aren't using it to pay for everyday items because of the volatility and all sorts of reasons why. Okay, so that's evolution of money driving the products. There's also some theories that are also driving blockchain. So people talk about blockchain as energy intensive, slow, difficult to do because you're decentralizing your ledgers and everyone else is having to compute the same things and it's kind of energy inefficient. But over time, some of these problems will get erased. And here are some really key theories which you might want to remember. So there's Moore's law. Moore's law was created by Geoffrey Moore, who ran Intel. And he started to notice that every 2 years, microprocessors were getting smaller, but the number of transistors that were on those microchips was also getting bigger. And he came up with a ratio that circuit boards double every 2 years in their processing power, which equates to the number of transistors that exist on a microchip. Of course, microchips now in your phone are incredibly complicated. Yeah. I've got a BBC Micro at home, and you can take the lid off it, and then you can look in and you can see the microchips, and you know the number of transistors in those microchips is less than 100. It's really, really small. In your phone, the number of microchips are in the billions. So the number of transistors are in the billions. So we've come a long way. Another concept similar to Moore's law is Carlson's curve. It was identified by a guy called Carlson, and he said that your processing power of computers is exponentially increasing. And he discovered this through DNA sequencing technologies. He noticed how fast and more rapid the sequencing process was taking over time. So he came up with that concept of an exponential curve to demonstrate that. There's Wright's law, which is the learning curve. The more you do of something, the more efficient the system becomes because you start to understand it better and you start to manufacture at lower cost. Yeah? So computer chips are going to get cheaper in the long run. That's what that's saying. Henry Adams' curve. Now this one's an interesting one. People talk about climate change. But if you look at any technical data on the growth of an economy, what you find is that the more economy grows, the more energy consumption it uses. We are not going to reduce our energy consumption. To try and reduce our energy consumption is impossible because we have to have growth, because growth leads to prosperity. People want prosperity. And to have that growth, you have to increase the amount of energy you consume. So we can't get rid of the energy use that we currently have. We can't do less. Yeah? It's okay, you know, telling people take a bike, but you're not cutting down your emissions by any margin anywhere close to the amount we need to reduce our carbon footprint by. You as an individual will not be able to do it. So in order for us to succeed in society, we have to find better energy sources. Nuclear energy, fission or fusion, whichever one you want, right? They're future technologies that are going to create the power of the future without increasing the CO2 emissions and the greenhouse gases. Wind, air, solar, hydrogen, whichever other form of power we think of, is going to reduce our carbon footprint. And so we need more of those technologies. In order for us to prosper in the future, Henry Adams' curve tells us that we're going to use more energy. So making an argument that Bitcoin uses a lot of energy isn't a rational argument, because we're going to be using more as we get bigger. So third world countries have become second world, first world are going to need more energy to support their economies and reduce costs and decarbonise. Now the last one in this list here is Metcalfe's law. Metcalfe's law describes how the increasing importance of a network is based on the number of nodes that the network has. Metcalfe discovered this concept, and it's called network effects. Discovered it from the use of fax machines. So if you have one fax machine, that's one node. How useful is one fax machine or one mobile phone? Zero, right? Because there's no network. If I have a phone and you have a phone or a fax machine, whatever, Metcalfe used a fax machine because it was in the 70s, we have two nodes. Now you can talk to me. Is that helpful? More helpful than none, but not very helpful at all, because I probably won't see you until next year, and we probably don't need to call each other. So it's pretty useless, right? So what we need to do is we need to get other people to have mobile phones, don't we? So if we give mobile phones to everybody, now we've got a network. We've got lots of different nodes. We've got lots of different people using this technology. Now we can communicate. We can communicate to everybody. The whole system becomes more efficient. It's a little bit like a football match. The reason why we like football is because there's crowds. If there were no crowds, football would be boring, because there's no roar, there's no cheer, there's no chanting. So in order to make football more popular, we need a network effect of great football on the pitch, but also big crowds in the stadium. We have to get both sides of the market to work. Facebook doesn't operate without people posting. It doesn't operate without people watching. You need both sides of the market. So when Facebook and social media emerged back in the mid-2000s, they had a lot of venture capital funding to create that network, to create both sides of the market. So Amazon, Facebook, they weren't profitable for years and years and years, because venture capitalists saw the network effects of creating a network in the first place before monetizing the network for advertising. And so once they got a network, advertisers wanted to advertise. Other people wanted to use Facebook. Other services could be added to increase the use of the network. So now Facebook is this ginormous platform which benefits from these huge networks. So in crypto, what we've done is we've monetized the growth of the network. So if you invest early in a network, you get the maximum rewards. Because when you invest, guess what? You've got the least rewards. So the offset of buying coins is saying, invest in me, we grow it. When it's grown, we have something better to do with it. And at the same time, because you've invested early and bought the coins, you get the greater benefit in the long run. So the system feeds itself and you get payback. So the future of crypto enables Metcalfe's law to be more efficient in its development. We've talked about the oversupply of fiat currencies. And then the last one is FOMO. What's FOMO? Fear of missing out. So if you were buying crypto on Friday, and you were telling your friends about crypto on Monday, you'd be telling your friends you've just made 10-15% profit by investing in cryptocurrencies. Your friends are like, 15%? Crikey, I want more of that. So they invest because they don't want to miss out on the opportunity. So for cryptocurrencies create this fear of missing out because the volatility is so mad. It goes up so quickly. If you invest in stocks and shares, if it goes up by 2% in a year, you're happy. Yeah. I was telling my wife I had some Tesco shares. I used to work for Tesco, and while I was working there, you could invest. You could buy into Tesco, and you could get some shares. So a lot of people who work for Tesco were buying Tesco shares for their pension plan. While I was there, Tesco share price was going up. When I left, share price went down. Nothing to do with me. Okay, but I still got those shares. I've had them since 1993. My dividend per year on the shares that I bought while I was there is 12 quid. 12 quid, right? The value of those shares I've made in a month on cryptocurrencies. The total value of those shares, total value. It's 20 years I've had those shares and I've made it in 1 month. So the volatility of cryptocurrencies is so severe and the growth is so rapid, it puts everyone in a frenzy because you want to buy in, you want to get into the market because you don't want to miss out on those massive returns. Because where else can you get those massive returns? Nowhere else. So people get in and then they get fear and greed going through the system. And of course, when it goes up, everyone's happy, everyone's buzzing, you get greedy, buy more, buy more, buy more, until the point where everyone thinks, hang about, this has gone up a lot. I'm going to take my money out, I'm going to put it somewhere else and save it because I've made so much money. It's fantastic. And so, of course, then they start selling, and then the price starts to drop. And then people go into a panic mode. The price is dropping, they sell. And all of a sudden, you've got a down spiral. Of course, people are selling. And that's why you get these massive volatility spikes. If you think about the long term, and you trust in the concepts, and you believe in the cryptocurrency, those volatility spikes will even out and start to spread out over time. So if you want to invest in crypto from now, because I know you've sold it, if you wanted to invest, you should be thinking about the concept of dollar cost average, DCA investing. So putting a little bit in frequently over time to even out the ups and downs. That's if you believe in it. If you don't believe in it, don't invest. It's like buying good art, isn't it? You don't buy a crap painting that you don't like and put it on your wall just in case it might go up in value in the future. You buy art because you like it. Yeah, you like the idea of it. You think it's cool, right? And then you put it on your wall, and then in the future you hope, oh yeah, that's worth something, I'll sell it on. Give somebody else the benefit of my artwork. So with Bitcoin, it's about investing in that idea. Are you a Bitcoiner? Are you a maximalist? Do you believe that it's going to go up over time and keep going up in the future? Then it's worth just buying and holding it. Wouldn't recommend trading it unless you're a trader and you've been on a trading course. Anybody heard of the hype cycle? Okay, so Gartner, big IT firm, found that technology has a pattern of behavior. And what happens is someone comes up with a concept like blockchain, like artificial intelligence, whatever, right? Virtual reality, anything like that. And people get excited about it. And they get excited, and so people start talking about it and promoting it and talk about it online, and academics get involved and start writing papers on it. And over time, that technology gets swept up in a wave of interest. And we go up this hype cycle. And we get more interested and more interested. And then venture capital companies go, God, I've heard about this technology. Sounds really exciting. AI, ChatGPT, we need to be involved in that. Let's start putting money in, let's invest, yeah? So venture capital companies start investing. And then we start to get to this point where we have a peak of inflated expectation. People start to realise that, hang about, this technology that you talked about is not as good as you said it was going to be. There's all these problems associated to it. So, for example, AI is, taking over humanity. Yeah. Blockchain is going to cripple the financial system. Bitcoin is evil. We get a big sell-off, and the interest plummets. And of course, you get other products coming through. So you then end up in this trough of disillusionment. Someone told me this technology was really good, but actually it's way off, it's boring, it's not working, it doesn't work, VR, it gives me a headache, there's all this stuff. It's hopeless, we're not going to invest in that anymore. And then as time goes by, the technology improves. It becomes more useful, has more utility, it gets more traction in the market, people start to adopt it more, you get the network effects and all those other benefits. As people start to learn, what is this technology about? What is it actually doing? And then eventually we end up on this plateau of productivity. The technology has progressed to a point where we understand it, we know what it does, we're happy with it. So the motor car is the motor car is here really, isn't it? Yeah? Where do you think Bitcoin and crypto are on this curve? Where do you think they might exist?
I think maybe they not go through the drop of disillusion. They're now starting to head up to a slope in life.
Perfect. Yeah, bang on. So we've had all the hype, we had the big cycle while we're in the COVID, everyone got so super excited about Bitcoin. Venture capital companies have invested, people have invested, the network's got bigger, but the utility doesn't exist. We can't still spend our Bitcoin, can we? We can't trade, we can't transfer it, we can't use it to buy everyday items. So we're down here, the big crash came along, and now we're starting to really kind of get into the grit, into the knowledge of it. And I'll just show you. So there's the circle where you got. Here's your peak of inflated interest. Here's your trough of disillusionment. Here's your slope of enlightenment. We've gone through that little hype cycle. Now we're here in the next growth phase, the utility phase, actually working with it. The problem is we don't know how long that's going to be. Is it going to be up here? Is it going to be down here? Where's it going to get to? I'm not skeptical at all about blockchain. I think it is the next phase of the internet. Decentralization is the next step of the internet. So my view of the world is this is going to be up here. And it's going to be way, way, way beyond this. So, we're through the roof here in terms of its adoption. We're still at a very early stage of adoption. I talked to my friend, he works for an IT company, and I talked to him about Bitcoin. I said, have you got any yet? And he's like, no, mate. Why do you want Bitcoin? Why do you want blockchain? Seems stupid to have blockchain. Why do you want lots of computers doing the same activity all at the same time when you can have one computer doing the same activity all at the same time? And that's his mindset. And until people like him change their mindset to realise the benefits of decentralisation, we won't get full adoption. So what's slowing everyone down? The lag effect, the lack of utility. We've got these coins, we're building these layer 1 foundations, but no one's building the layer 2s yet. There's not much going on in there. So people can't interact with the layer 2s, which means they're not that bothered about the cryptocurrencies. It stays in that layer 1, in that foundation layer. So people like you who invest and speculate, they're the ones who are investing in the layer 1s. They're the ones creating it and getting the interest. Until it breaks out into layer 2 decentralized applications, which do exist, by the way, but no one's using them at any great scale. The concept of the Field of Dreams, there's a film called The Field of Dreams, you might not have seen it, but the phrase is build it and they will come. We're still in that build phase. We're still building the theatre of dreams. We're still building the environment. So we're waiting for it to happen. Volatility puts people off. How can you use Bitcoin when it goes up and down so rapidly in value? How can you use that to buy stuff on an everyday, on some apples and fruit and pears down at the grocery store, yeah? If the price is just going like this. So volatility puts people off because they don't trust the money. It's not stable enough. The reason why it's not stable enough is because not enough people own it to even out those fluctuations. But volatility is also a double-edged sword because it gets people interested in using it because you get FOMO, you get these rapid increases in value. People dive in and spend their money, hold on to the Bitcoin, put it in a cold store. Uncertain regulatory environment. We're going through a phase now where lots of regulations coming in. The European Union have their own policy on digital assets, very clear policy on what a digital asset is, and they're developing a digital coin. The UK have come up with a policy around crypto. The US are still working on it now. So over the next 2 or 3 years, you're going to see the evolution of Bitcoin into mainstream once the regulations are in place. And then the other critique is energy use. This stuff just uses too much energy. But like I said, no growing economy grows without using more power. So it's not a particularly good argument. So where did crypto evolve from? So everyone thinks, it just emerged in 2009, right? It didn't. Crypto emerged in the early days of the internet by a group of guys called cypherpunks. And these were people who were kind of anarchists, San Francisco, ex-hippies, computer programmers who believed in privacy. And so they went around trying to come up with encryption codes. So Bitcoin and all the others developed out of cryptography, the idea of being able to have privacy on the internet by being able to encrypt your own information. So all Bitcoin is, all altcoins are, Ether, XRP, are encryption codes. And encryption works like this. There's a private key, which you own, the seed phrase, your encryption key, and there is a public key. And you have to be able to match those two up. in order to get access. Yep. So if you go talk to some computer sciences around cyber security, they'll be able to explain to you how cyber security works, what encryption's all about. And that's all that these digital assets are. It's just encryption codes. Nothing more than that. A guy called Adam Back created something called Hashcash. He created it to stop email spamming. He didn't believe it was ever going to be a money system. But he created the concept of proof of work, which Bitcoin runs on, to prevent people from sending out thousands and thousands of emails across the network. And of course it was called spam, and in the 1990s everyone talked about spam. Spam mail, spam emails. Now we just get spam all the time and we just ignore it, don't we? We just sort of vape over it, don't we? We just sort of glance over it and move on. And of course now we've also got privacy laws which stop people from sending out unsolicited emails. On the back of Adam Back's Hashcash, his anti-spam technology, Satoshi Nakamoto created peer-to-peer cash. And you can go and read the white paper about it, and it explains it in detail. Since 2007, we've been through this crazy crypto kind of environment, which I'm calling the Wild West era, which has led to bubbles in the price and volatility of crypto. It's led to people calling it a Ponzi scheme. It's also led to people creating Ponzi schemes. Somebody once created something called the OneCoin. It wasn't anything crypto at all. It was just a fake coin. And they got people to invest in a fake coin. Of course, they got found out because there was no code. There's no programming, there's no protocol. And of course, all the money disappeared and the people got put in prison. The lack of utility leaves people to be skeptical of what it's all about. Why is this crypto around? What's it doing here? What's it for? It has no purpose. Of course, we've learned so far today that there is some purpose to it. People started taking the Bitcoin code because it's open source and started developing their own technologies. And then we got founders and foundations created. Of course, we have that huge volatility in the market, causing havoc. Okay, so now we've sort of entered into a legislative era. Regulations are coming out. The American SEC have sanctioned and tried to take more control over this crypto environment. The Americans want to own this environment. They want to be the leaders in crypto, because if they can get all the coins in their custody, they can then issue when they want to, and they can grow with that. So the Americans are very cute. They were cute with social media. Social media was the growth engine after the crash in 2007. They allowed social media to develop without any controls. Now, if you notice, you're starting to see more controls coming into social media. Yep. The landscape for social media is not as friendly as it once was. And that's because we're moving into crypto now. Americans have got bored of social, they've developed that, made loads of money out of it. If you look at the S&P, it's called the Magnificent Seven. The top 7 companies in the S&P provided all the growth in the S&P 500 index. 96% of the S&P index is delivered by 7 companies. 7 out of 500. Guess which ones they are? Google, Facebook, Apple. Yep, those big organisations. Out of the 2007 financial crisis, they let them run riot. They let them do what they wanted to do, because that was the growth engine for America to get out of that crisis. We didn't have anything like that in the UK. We went into austerity because we didn't have a growth engine. We had to claw back the cash that we'd put into the banks, and we've we've pretty much failed at that, and that's why the UK now is really heavily indebted. It's the most indebted, one of the most indebted countries in the world. Yep, we can just about 85% of our GDP is debt. Value of debt. So around the world, things are happening. Regulations are coming in everywhere, and they're starting now to create this global financial system, global product for Bitcoin. So we've got activity. Here's an international landscape of different companies having a go at blockchain. So things are happening, right? Things are going on. Nike, we know about. Starbucks, do you know about Starbucks? So they're creating NFTs. Meta, NFTs. A whole range of different types of products and services, all working on blockchain technologies. So if you think blockchain's just going to disappear, I'm afraid you're going to be wrong. Because once momentum gets created from these big organizations, it's going to then filter into the retail environment, and people like you and me are going to start buying and investing and holding on to NFTs. When you go down the rabbit hole of crypto, you find out there are more rabbits. You know, El Salvador have been adopted Bitcoin 3 years ago. Nigeria tried to do it, then they banned it, and then they realised they couldn't ban it, and they had to reissue it. Nigeria created their own digital currency. China have created the digital yuan. Digital yuan now has 230 million people using it. So it's starting to roll out. Obviously the digital yuan is a central bank currency, but it's just demonstrating the momentum that digital currencies are starting to get in the world. Bitcoin mining is everywhere. I saw on social media people using Bitcoin mining to create coins while also creating electricity from water power. So actually using a water wheel to generate electricity to then run the Bitcoin mining computers to then create the Bitcoin. So somewhere deep in Africa, people are creating Bitcoin. It's magical, isn't it? I think that's magical. Because that's going to aid the economy. You know, the problem with sunshine is it's in the wrong place. There's no sunshine today. There's no wind today. Our renewables are pretty much doing nothing. But somewhere around the world, someone's producing renewable energy. And if you're in Africa, you're creating you can capture a lot of sunlight. Well, the problem is, if you're capturing it in Africa, you can't use it in Derby. But those guys in Africa can use that sunlight to power computers, to create cryptocurrencies, to buy products and services from Derby to take back to the Congo. So their wealth and their economy can proliferate and grow. I won't go over how to buy crypto, you know how to do it. NFTs is going to be an interesting project for the future. People are going to start creating their own NFTs, artists, graduates from university, putting all their digital content onto NFTs, selling it. It globalizes the art collection, doesn't it? It creates a digital gallery. And it allows people to trade and sell art much faster, much more frictionless than in the past. So if you're in this space, and there are people in this space who are creating digital artifacts, NFTs, who've made absolute millions. There's a guy, have you heard of a guy called Fuckrender? Have a look at Fuckrender on the internet. He spells it, it's French, he doesn't spell it F-U-C-K. It's FVCK, but it's pronounced the same, right? He sold millions of pieces of artwork, absolute star. And of course, Bored Ape, £80,000 for a digital picture of a monkey with a cigarette in his mouth. And, so again, you've got a speculative bubble in the NFT market and NFT industry. So again, it puts people off because people don't know what the value of something is if it's so volatile. Is it low now or high now? Is it high now or low later? What's going to happen to this NFT? Why would I want to spend 80 grand on a digital image of a monkey with a cigarette in his mouth? But there are going to be winners and losers in that. The early versions of those Bored Apes are going to be worth millions in the future. But we're not going to be able to, potentially we'd probably miss the boat on a lot of that. You can go into crypto mining, so you can be a miner. I told you earlier, if you just set one machine up and run it, probably not going to make any money. It's going to use a lot of electricity, having a computer whirling away all the time, creating heat, which might be good if you're in your garage and you want some heat to heat your garage, but not if you want to try and get some coins. So you can now, rather than buy the equipment, be a cloud miner. You can pay into cloud mining and somebody do all the mining for you and you just get revenue from it, which is a great way. So you can invest a small amount, £150, and you could get £150 back in a year's time. The return rate's about 100% per annum, which is pretty decent, right? It's not to be sniffed at. You probably make more money buying crypto yourself and letting it inflate over time. So you could buy into cloud mining. You could become part of a mining pool, group your computers with other people's computers. You could buy lots of mining equipment. You could sell mining equipment. Yeah. The mining equipment you can get off eBay. It comes as a box. It just comes ready to go. You just need the software on it. It's all pretty self-explanatory. There's nothing complicated about it now. If you go back 10 years, people are doing it on their desktop computers. Of course, they realised it wasn't very efficient, so they wanted more efficient computers. So people have created a mining computer, which you can buy. So you can get one for £1,000, you can get one for 300 quid, you can get one for 18,000 quid. Depends on what kind of level of investment you want to make. But most people recommend that you don't go into crypto mining because the cost of electricity outweighs the return of investment at the moment. So the economics of it doesn't work. If, of course, you've got solar power running, or you've got water power, or you've got wind power, and you're creating electricity for free, then yeah, you might want to invest in mining. It's a good little business. Risk-free, just runs code, creates coins. So it's fairly trivial. You could create applications and start running them on one of the blockchains. So you could actually develop your own products and services. You could even create foundation tools. Okay, so talked about lots of different aspects of the environment of digital. Let's have a look at a few examples. So are you interested in football? Okay, so here's Socios. So Socios have a native coin called Chills, and you can buy an NFT in your favourite football team. These have been added this year. So now you can buy an NFT in Manchester City. If Manchester City do really well, that value of that coin is going to go up. At the moment, there's not much in terms of utility to that NFT, but as this platform improves, the likelihood is those NFTs will become more valuable. They'll give you an opportunity to get access to game tickets, get access to cheaper merchandise, get some vouchers perhaps, or even get you some in stadium discounts. So once you own these NFTs, they're going to be valuable, and that's Socios. So that's a big company. They have 200, 300 people working for them developing this product. So it's not a small company at all. This is one of my favourites, Cryptos. So this is a great concept. So you're watching your cricket and someone does an amazing catch, and you think, oh, that's amazing, that catch. I want to keep that catch forever. In Cryptos allows you to buy ownership of the footage of that catch and store it in your wallet. And in the future, somebody's going to say, oh, remember that catch? I go, yeah, here we go. There it is, right? And then further in the future, somebody will say, can we buy that? I want to buy that. I want to use it. So you're democratizing the purchase and use of social media, and it's allowing people to invest and buy into their experiences and share those with other people. If you want to watch that catch again, you'd have to go on Sky and look at Sky and say, where's the catch? Or go on YouTube and find a catch that somebody's recorded on the telly. You don't own it, you can watch it perhaps, but you can't share it and sell it and trade it in the future. So Cryptos is a great example. We talked about El Salvador adopting Bitcoin. So now if you go to El Salvador, you can use it as a currency to buy goods and services. NFTs are being sold in Argentina to issue flight tickets. So rather than getting a piece of paper or getting a little picture on a website, you now get ownership of your NFT ticket. What that will do for you is allow you in the future to trade it, because you bought that ticket, but say you didn't want to go, you could sell it to somebody else. In certain situations, that flight might go up in value. And so you could sell it on and make a little bit of money for yourself and decentralize the ownership of that ticket. So at the moment, airlines, they operate the model where it's a demand-based pricing model, right? So if you buy your ticket 2 years in advance, the demand for that ticket is really low, so you get it cheap. As it approaches takeoff date, the price starts to ramp up. And then just before the takeoff day, because it's 2 or 3 days before, it's unlikely that anybody's going to buy a ticket 2 or 3 days before a flight. The price drops. So if you invest in an airline or a company by buying their tickets early, you can sell them on in the future at a higher value and make some profit. So business models are going to emerge where people are buying up things early and selling them on, just like ticket touts do. But they're going to decentralize that. They're going to make that a legitimate activity. So art and design is going to be influenced by blockchain. And here you've got the Bored Ape Yacht Club. I think you've probably seen this before. But you can buy an NFT with a silly photo on. At the moment, it doesn't really give you access for anything. But if you have bought one of those, you could have gone to a party in New York about a month ago. It would have given you access to a party. Did you hear about it? So the Bored Ape Yacht Club came up with a party, and it was in New York, and they wanted to have fluorescent bulbs in. They put the wrong fluorescent bulbs in. You know, it makes your teeth glow and all that, and white go really dazzling. They put the wrong bulbs in, because if you put a UV bulb in, you have to have it. It has to be blacked out. It has to be painted black. Otherwise, the UV light's so powerful it can burn your eyes. They put in just UV lights. So people were dancing around and they were looking up at all these lights. And because UV is so powerful, all these people came out with sore eyes. They actually had burnt retinas from the party, which wasn't great for this company. But it just shows you what ownership of an NFT can do. It utilitizes the ownership. It gives you extra benefits. It immerses you in the experience because you have an ownership. You part own that company. You've invested in it. Therefore, you get the reward. So when you're thinking about your marketing concepts, marketing theory, you should be thinking now about how do you improve relationship marketing with NFTs? How do you build relationship with customers? Some of those things we've talked about already, the ownership, the involvement, the investment. Once people are committed to the cause, they're more invested in it. Think about your big music stars. What's your favourite music star? Dave, right? So you've been following Dave from the beginning.
Yeah.
If you'd have bought into Dave at the beginning, you bought his NFTs, when he became a big star, you could sell on your NFT for higher prices than you bought it for. You are invested in his future. You're invested in the success of Dave. And you monetize that investment. You're not just a super fan anymore. You're actually part of the clan. You're part of his world. And you can trade that to other people who want to be involved in that world. Yeah? So fan clubs, engagements and rewards are all going to start to go onto blockchain. The idea of a membership card is going to change. It's going to become more dynamic. So you'll be able to get more out of those memberships, be able to use them in different ways. Think about things like air miles and stuff like that, right? What if those air miles aren't transferable? What do you do with all the air miles you just accrued? Spent 5 years flying around the world, accruing air miles, and all of a sudden the air miles company goes bust. You've got all these air miles, can't use them. What if you decentralise that, put them into a currency which you could trade, or an NFT that you could use? So it's going to change the way memberships are organised. Affiliate marketing is going to get a lot smoother. Now you don't need to have to have an account with YouTube, because you can now get it directly from source when people click on the marketing, rather than you have to go back to the manufacturer to give you the rewards, the 10% commissions. As soon as they click on there, the network can then provide you with the reward straight away. Yeah. And extending services and event experiences. So you buy a ticket for your favourite Dave show, and before you get to the show, they send you information on the playlist so you can listen to the music before you get there. They might even send you a new song. Yeah. So when you come out of the show, your NFT activates some recorded content from the show. Now you can re-watch it. So no longer do you have to get your phone and record it by having to have some crappy images with shit sound. I went to Def Leppard. Do you know Def Leppard? So big fan of Def Leppard back in the early 80s, 90s. Massive, huge band. They come from Sheffield. Anyway, last year they were having a world tour and they were going to kick off in Sheffield, so they went to Bramall Lane in Sheffield. Really cool. Motley Crue and Def Leppard playing. And anyway, I was like, anybody want to come with me? No one wanted to come, right? So anyway, I went on my own and crashed a couple of cigarettes off the guy next to me, drank 6 pints on my own, just had a bit of a laugh, just mingled in the crowd, bit of fun. And took some footage, sent some footage to VZ. Well, look where I am. When I was there, right, the sound was like that. It was just coming through you, pounding your chest, like boom, 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 boom. Absolutely going right through you. And it was like, awesome experience of this wall of sound from guitars and drums and stuff. And of course you had the light shows and all that. So I recorded it. I was showing VZ, look at this, man. And then when I got home afterwards, I thought, oh yeah, let's watch that footage again. Started watching it, I was like, oh. The sound was so bad, nothing was there. So NFTs and tickets would give you access maybe to some footage or to some live content or new songs afterwards to extend the experience of the show, to make the show better, elongating it beyond the time frame. Yep, which is the biggest problem with service marketing, right? It only lasts while you're there. So Bitcoin can get involved in that. Product marketing, like Nike. Nike just bought into a virtual shoe company. Nike just starting to find out how to operate in blockchain. Yeah, it's not a big business now. You can still buy these things. You can buy your NFTs of Nike trainers. I'm sure if you buy NFT Nikes, it will make you money in the future because people are mad on trainers. I didn't even know there was an economy in second-hand trainers until about 6 years ago. I didn't realise it existed. People buy second-hand trainers, don't they, from the 80s at astronomical prices. Well, blockchain can verify those trainers, so it can give you a real-world asset token to go with your trainers, just so you can track it around the globe. Your blockchain can create a digital version, so you can use it in the digital world, in Fortnite or whatever game platform you like playing in. In these sorts of games, you can create the content and then sell them on. So in-game, in the virtual world, blockchain will enable lots of new business models, new ways to engage, and new ways to interact with the experience. X platform is going to reward your social capital. So when people follow you and tweet you and retweet you and watch you and read you, they're going to be able to monetize that. So the more people who watch what you're doing gives you more social capital. The social capital will get rewarded with coins. At the moment, you get rewarded by advertising content being spread around your stuff, right? In the future, you won't need that. You'll be able to get rewarded just by people watching. So it's a new revenue stream. Okay, so I think we're coming to the end of the presentation now. And just like to just sort of talk about the future, where we're going, just to sort of summarise and sum up what we've done. So the first thing is that decentralised finance is going to be more legitimate. So at the moment there is a whole range of assessment vehicles called ETFs, equity trading funds, being created so that people can buy into the digital world, the digital crypto world. Those things are going to come out in 24. Digital currencies are going to be more available. So we've got the eNAN, we've got the eYuan, digital yuan. We'll have a European version of that. We may well have a British version of that as well. Talking in the newspaper about the Britcoin just yesterday. Some of these things are a long way off because there are lots of issues. You know, when you're dealing with money from a government, it has to be working from day one. And that's the biggest problem with digital currencies. You need them to operate. So they need people like you and me to buy them and piddle about and play with them at low levels before it can become an adopted product across the world. New applications and utilities for NFTs will emerge. We talked about a few of those. Tokenization, everything having an encrypted code on it. So real world assets, digital assets, all have a little bit of crypto code on it, which identifies it to whoever owns it. And you can store that in your digital wallet. Fan rewards are going to be something that probably emerges. Socios is a great one. They've been in this game for over a year, and I think that's one of the most progressed concepts so far. They've got all these brands on board: Arsenal, Barcelona. Football's the biggest sport in the world, right? So where would you want to do your first trade in the football world? Images of Messi, NFTs of Messi, you know, all that sort of stuff is going to emerge over the next couple of years. Digital replicas are going to become quite popular. So every time you buy something now, you might get an NFT with it, and you can put that in your cold store wallet or your hot wallet, and that will start to get people interested in cryptocurrencies. And you can buy all these things. These things exist, but just very low level, and people are like, well, I don't really care. But people will care, because people will start to listen to the stories again of volatility, of inflated pricing, rapid growth in value. People start to hear about that, and you'll get FOMO again, go through another cycle. And that's where these technologies will start to then embed themselves into the everyday language. Collectibles will continue to progress. People said the NFT market was dead, but you know, it's still there, it's still going, it's coming back, people buying in. In-game ownership will be a big thing. Decentralization of these big walled gardens will allow people to actually physically own content in a game, contribute to a game, and get rewarded for being in a game. It will start with your kids, you know, little kids, 8-year-olds.
Scan for a sign.
Well, we're nearly finished, so. So we're at the light is at the end of the tunnel, but is it a train coming in the other direction? You know, the concept of crypto is vast, and it's going to people get confused by it. Hopefully today I've tried to kind of delineate it and to provide you with a bigger overview of what it actually is and what it does and what's happening, where it's coming from. Welcome to the hash wars. You know, the concept of Bitcoin it could be frightening in a few years' time, because once people realize you can own an asset which has value, countries like America, China, will want to produce it and they'll want to own it. And they'll be fighting it out amongst themselves to gain control of it, because you can't print any more of it, you can't create any more of it. It's a limited supply. And so it's going to create what we call the hash wars. And all I mean by the hash wars is people running mining equipment to try and generate as much of the coins as possible so that they can then store those and hold those, because crypto is going to be that fundamental in the way we work in the future. So in 10 years' time, you'll remember this presentation. You'll say, I remember when Andy taught me that at uni. Look at it now. What a massive difference it is from then. So this is where you are at the moment. Here are some adoption curves for different technologies. The telephone, the jet engine, the car, gaming, mobile phone network. So look at mobile phones. So the mobile phone started off in the 60s, grew into the 70s. Yep, mass adoption in the middle of 2000s. Your Bitcoin's right at the bottom. Hardly scratched the surface in adoption. We've got a long way to go before crypto, Bitcoin, NFTs, digital assets become part of everyday life. But it will be within the next 10 years. So get ready for it. If you notice the adoption curves here, what do you notice about the adoption curves?
Becoming more vertical.
Correct, yeah. So down here, it took ages for technology to disperse into communities. Now, the adoption curve is rapid. So Bitcoin here. Yep, very quick, very fast adoption. Okay, disclaimer, risks. This is the our government's guidelines on cryptocurrency. You could lose all your money if you invest. Don't expect to get protection if you lose it. You might not be able to sell it. It's complicated. Don't put all your eggs in one basket. If you want further information, click on that link. Talk you through it. So, in summary, crypto is very, very exciting. It's an incredibly important space that we're going to be working in within 10 years' time. And you, as students, need to be involved in it. You need to understand Web3 technologies. You need to understand cryptocurrencies. You probably need to go down to the level of understanding what the cryptocurrency is there for. What's it been built for? What's it created for? Talked about a few of the different ones. Is it banking? Is it gaming? Is it meme coins? What crypto is it for? And that's it. Thank you, guys. Thanks for your attention. Hope you've enjoyed the presentation. Hope you found it useful. Any questions?
Somewhere like digital art, or just some of the things in general, I find it tricky to find what its functionality would be, like digital replicas and things like that. What would be the real world value in that? Because how can it be valuable?
Yeah, so if you think about, so what you need, in order for a system to work, you need all the building blocks to be ready to go.
Yeah.
If you don't, then it can't. So at the moment you've got walled computer games. They need to be decentralized to allow access for content to be created. So there are companies like Roblox, Minecraft, that have created environments that you can provide content to. So Roblox business model is decentralizing. There is some centralization on it, but creating artifacts to go in the game is possible now. So they can readily turn that into a blockchain game. There are games being developed that are obviously nascent games, so very new games that exist, and you can go into de-apped games, and you can do these things in those de-apped games. Yeah. If you buy an NFT for a Nike pair of trainers, yeah, you get a photograph, put it in your wallet. Not much, but you get not much more utility than that. You can show your friends. So at the moment, it's a collectible. It's not got much utility. But when the walled gardens decentralise and open up, you'll be able to say, okay, I'm going to use my Nike NFT trainers on my avatar in my game content. So when I go into a virtual environment, I'm walking around with my Nike NFTs. So they're monetizing the in-game. At the moment, you buy into FIFA football, and you play FIFA football, and of course you've got all those advertising hoardings around the side. So companies are paying for having those ads in that game. If you enable those ads to be changed and swapped via blockchain, then you can decentralize it and you can allow the game to exist. And people can then invest very quickly in putting their content on those games. So imagine this. You're an ice cream seller in Derby. This is a very extreme version, an example, right? But you're an ice cream seller and you're coming around this corner here. Someone's playing FIFA. Theoretically, if FIFA was decentralized and on the blockchain, you could target the ISP address for this location to put an ad on, a local ad, that you're coming around the corner with your ice cream van and you'll be waiting outside.
Yeah.
And you could do it. So if it's decentralized, you can do that because you can make the process faster and quicker. At the moment, you have to go to EA Games, sign a contract deal. They then need to put it in the update. When it goes in the update, it goes onto your computer or your PlayStation. You play the game and you see your ad. Well, the flexibility of that is too weak.
Yeah.
The dynamicism of that is too slow.
I suppose if it's decentralised as well, there's less issues with like sharing of information, things like that, with targeted advertising, so you can
Yeah.
actually aim it at people without people being concerned about what company can own.
Well, you're still going to have data protection laws,
Yeah.
but you are going to be able to target people because you'll be able to draw on data. So you know that Philip Hurst, 12 years old, lives in that house over there. Obviously, you can't advertise at kids, but the 20-year-old Philip Hurst is playing FIFA in a house around the corner.
Yeah.
He's provided you that data. He's given permission for you, that data to be used. That data is then aggregated with the advertisers, and the ice cream man is using the data to target Philip because he loves ice cream, because he's already told us that. And you know, you use big data, Facebook data, analytics, to create the same things that you would create in social media, which is targeted ads.
Yeah.
But this time you can do it with a physical service, and you can do it faster and more rapid. Everything at the moment is centralised. When it becomes decentralised, people get access to more information. They can use that information quicker. They can start to do different things with it. So some of the business models that we haven't thought about yet are going to emerge in the next 10 years. Half the things we can't think about. We can't actually mentally go, oh yeah, that's a great idea. But some of the things we can, because what we're going to do is we're going to transfer some of the old world ideas into a digital world concept and blockchain concept. And then eventually people go, well, if you've done that like that, why don't you do this like this, this and this instead? So new business models will emerge. Yeah. So to answer your question, it's hard to do it now, but it will get easier and easier and easier as the environment gets more and more developed and more decentralised to enable you to do it. Any questions? No? Okay, great stuff. Okay, fantastic. Here's some fun facts to have a read about. Satoshi Nakamoto is the guy who wrote the paper on peer-to-peer learning, peer-to-peer learning, peer-to-peer coins, currencies. Nobody knows who that is. They don't know if it's a real person or whether it's a group of people. So it's a mystery about who it is. It's a bit like Banksy. No one actually knows. Somebody must know who it is, but we don't know who that is. Who knows that, who he is, kind of thing. In the early days of Bitcoin, lots of Bitcoin were used to trial the system. Some of those have been lost because they're on the seed. The seed phrase has been lost. They're in cold wallets, but no one can get access to it. So there's about 1 million Bitcoin currently unaccounted for in the Bitcoin environment. So there's 21 million Bitcoin. That's all that's going to get produced. 1 million of those have unknown owners. There'll also be a whole bunch of people who have lost their Bitcoin because it was on some crappy hard drive back in the 90s, back in the 2000s. The FBI have one of the world's largest Bitcoin wallets, $120 million from shutting down people's accounts. Lamborghini is the first car company that accepted Bitcoin as payment. Tesla tried it, didn't they? But they scrapped the idea. So it's very early days. Somebody paid 10,000 Bitcoin for one pizza. Imagine that. But he's sick now. James Howell made headlines in 2013 after it merged. It accidentally thrown away a computer hard drive containing 7,500 Bitcoin. You see, if you go back to 2013, this stuff was valueless. There was no money to it. I had undergraduates in 2011 writing papers on Bitcoin and the future of money. And even at that point, I was like, the computers weren't very good. You know, you had a massive box on your desk at home. You know, and you couldn't imagine a world where people would store money on a computer. Yeah, just didn't make sense. But people were talking about it way back then. 2015, 802 people in the US reported their Bitcoin income to the IRS. Now, of course, everybody has to in America. You're all right. In the UK, you don't have to do. There's no tax on crypto at the moment. So you don't have to pay anything on it. You will in the future though, because you'll have to pay capital gains on all your profits. The 3D Bitcoin model was tied to a weather balloon and sent into space. I did that in Sheffield. We had this big balloon and we put gas in it, and we put items in a basket, and like a teddy bear, and it sent it into outer space. Okay, great. Okay, that's it. Thank you very much for your time. Hope you enjoyed that. Hope that was useful. Hope that explained things clearly and you got the knowledge that you needed from it. What's your next steps? What are you going to do now? What's your thoughts about Bitcoin and crypto and blockchain?
It's quite interesting, definitely. Like, I think maybe once I get out of uni and stuff, and we start looking at investing into it again, see where.
Why are you going to wait? What's the point in waiting?
So I want money, so I can actually invest it instead of
Yeah.
need to buy food rather than Bitcoin at the moment.
Yeah. So do you buy coffee downstairs?
Usually I try and, not because it's quite expensive. But
I know what it's like to be a student. You know, you're always looking for a few extra quid for a beer,
yeah.
and it's hard to invest. But have you thought about just putting small amounts in,
Yeah, I'd be.
a few pounds a week,
Yeah.
that kind of thing, rather than big splash? If you dollar cost average over the next 10 years, you'll come out better. We're in a cycle of growth, so the likelihood is the coins are all going to go up over the next 2 years. So expect it to go up. But even if it went down, you would over time you would benefit, because from what we talked about, you can see where the growth is coming from and how the internet is going to develop and decentralize. So these coins are going to be a pivotal part of it. So think about putting small amounts in, maybe 1 cup of coffee a week. You'll still benefit in the long run. What about yourself? What's your going to take away?
This session.
Yeah.
I knew kind of most of the stuff before, so I just guess over the years it's something to look out for.
Right. Okay. So what would you do as a graduate then?
Like crypto.
Yep. So you're going to graduate in 2 years' time. What's going to be your first step?
Look for work in the sector, there's different options.
So looking for jobs, career path in Web3 technologies. Yeah. Look at layer 2 perhaps, where people are creating the applications. Be a lot of growth in that area. Yeah. Anything else?